The best time to invest is when the entire stock market is down and in the red. During times like now, investors know how to move money through the economy and its cycles, and we want you to get a piece of the pie. So make sure you stay with us till the end, because it's the perfect time for the rich to get richer and the inspired millionaire or billionaire to get in on the action. Welcome back to Reign Supreme, a channel to impact influential, powerful minds. When the economy is down, it's common for one to be cautious about investing. So we're going to help inspire you to move money around in times like these. Why? Because a lot of companies that are overlooked and undervalued with declines in stock during a crisis may present good opportunities. Overlooked and undervalued business stocks are stocks that are continuously profitable and have good long-term growth potential, but whose share price is low in comparison to many of its rivals. It's worth noting that stocks like these might be excellent selections for disciplined investors who are ready to wait for stock market opportunities. No one likes losing money. Therefore, while the market is currently looking rough, people wonder if it's the right time to invest. Simply put, the answer is yes. So in this video, we are taking you in depth and looking at our list of 10 stocks we're investing in right now, in hopes to help you better understand how you can become an active investor in the market. Let's begin. Number 1. Southwest Airlines. Airlines have been struck particularly severely since the outbreak of the epidemic. Not only are airline stocks dealing with continuous travel bans and drastically decreased passenger numbers, but they're also dealing with record high gasoline costs. As a result, it should not come as a surprise that many airlines buying stocks are still trading below their levels prior to the epidemic in the stock market. However, despite the risks, experts still believe that Southwest Airlines and other low-cost carriers are overlooked stocks for now, and hence a good investment for the portfolio right now. While there are numerous inexpensive aircraft stocks in the stock market, Southwest Airlines sticks out for us, not least because of its rather good balance sheet. In April 2021, Southwest Airlines exceeded its pre-COVID value in terms of its stock price performance. However, the stock market has now taken a nosedive. As a result, Southwest Airlines stock has dropped more than 25% in the last year. So, it is a strong possibility to purchase this overlooked stock that is now available at a substantial discount in the stock market. Number 2. Cigna. One of the world's largest health insurance companies, Cigna provides coverage in more than 30 different nations all over the world. It has contracts with over 99% of U.S. pharmacies, making it one of the most comprehensive drug delivery systems in the country. It has increased its footprint in the fast-growing pharmacy industry, giving it more power over pharmacies in terms of medical costs. Despite the headwinds caused by COVID, the firm has done well in the last couple of years to increase its subscribers and the general quality of its service. The company's first quarter net income per share in 2022 was $3.68. This was a significant gain over the same quarter a year ago, when the company earned $3.30 per share. In addition, it pays constant and predictable dividends and buybacks to shareholders. Its dividend growth rate over the last 5 years comes in at an astounding 93%, and its yields of 1.7% is quite enticing. Although CI has consistently performed well, the stock trades at a forward sales multiple of 0.5 times, so it's an awesome opportunity to invest in this stock. Number 3. Philip Morris. Smoking is on the decrease, but tobacco stocks are still a good place to put your money to work. And the vanguard of this is Philip Morris, the second largest cigarette company in the world after China Tobacco, which is controlled by the Chinese government. But Philip Morris is still behind some of the most well-known tobacco brands in this market, like Marlboro and L&M. And most importantly, reliable stocks like Philip Morris can be kept in your portfolio for the long term, regardless of how the overall economy performs. After all, tobacco is a commodity that customers want at all times of the year. Furthermore, Philip Morris does what other major tobacco companies do to combat declining demand on a per capita basis. It raises its prices. For this reason, Philip Morris is one of the most overlooked and undervalued buy stocks anyone can get their hands on, and has a current running yield of 5%, which is rather tempting. However, it is important to note that Philip Morris's share price has underperformed in recent years, and the company's stock is now trading at a discount in the stock market. Number 4. Starbucks. We love branded companies, and there are few brands with more power than Starbucks. Its stock price is down 35 in the last 6 months, from $115 to roughly $70. Business-wise, it's all looking good. The company recovered well post-COVID and even brought in almost $30 billion last year. And as we see the world getting back to normal, we think more and more people will engage with Starbucks. People don't want to go back to the office, but they do want to get out of the house. Starbucks has the culture of the entrepreneur, writer, designer working from their coffee shops, which fits really well into the current narrative. Plus, they make decent coffee, depending on how bad inflation gets. We are treading carefully here as the rents and commodity prices rise. We still might see a second dip in the price. Number 5. Walt Disney. In terms of streaming services, Disney is crushing it right now after the final game. Everyone believed it was done, but they're still putting out pop hits. On the other hand, Disney Plus is rapidly growing in every location, and they're giving Amazon, Netflix, and HBO a run for their money. In the previous 6 months, we've seen the stock fall 35%, and this price point is really important since Disney's stock price has returned to the price point. Essentially, you're getting 5 years of Disney corporate growth for the same amount. But in the last year, Disney's digital business generated $67.4 billion in revenue, and the company's excellent brand, service, and content make it a formula for success. And with Disney, it's difficult to predict, but we don't expect the company's stock price to fall in the next year or so from here in the stock market. And it's expected that investors might earn a return of more than 50%. Number 6. Meta Platforms. Meta Platforms, formerly known as Facebook, is the world's biggest social media corporation and is also the brains behind Instagram, Messenger, WhatsApp, Oculus, and a slew of other brands. As a result, Meta Platforms are used by billions of people from all over the globe. However, Meta Platforms, which were recently renamed to emphasize their ambitions to target the metaverse in the next few years, have had a difficult time in the financial markets. For instance, the stock price dropped by 30% in the previous year, and over the last 5 years, Meta Platforms' stock price has only gone up 50%. But on the other hand, during the same time span, the popularity of Twitter, another popular social networking tool, has increased by more than 2,000%. Consequently, the decrease in Meta Platforms' share price is a typical example of an overreaction by the larger markets. And it's important to note that for the first time since becoming public, Facebook's monthly active users have also decreased. Furthermore, when this was reported, Meta Platforms' market value was reduced by approximately $230 billion in a single day of trade. Experts believe that Meta Platforms is one of the most overlooked buy stocks on the market right now. Because it does not pay a dividend and has a P/E ratio of just over 15, making it a value stock in the market. Number 7. Adobe. Adobe is a far larger company than the PDF reader you have installed on your computer. After Effects and many other tools are by far the most popular tools in the creative economy. Similarly to Airbnb, Adobe's stock price has dropped 42% in the previous 6 months and is currently trading at less than $400 per share in the stock market, which is significantly better than Airbnb. But Adobe has been profitable year after year since numerous financial experts became investors in 2017. Anyhow, this is a tremendously lucrative brand in a market that is developing faster than ever before, with goods that are becoming better every year. And it is our belief that the emergence of the Web3 digital market will lead to at least a 40% retracement. And we're betting hard on companies that will play a role in creating this new market, making its stock price increase in the stock market. Number 8. GoPro Inc. GoPro, the maker of action cameras and drones, is making improvements to its fundamental business processes in order to increase shareholder returns. After its high-profile NASDAQ debut in 2014, the stock soared to $65 a share, but fell to below $10 in the stock market as investors judged that the company was too much of a one-trick pony. But a major overhaul of the company's operations involves selling its goods directly to customers through the GoPro.com platform. And with such great brand awareness, the company's products stand a good chance of being searched out straight. But in the second quarter of 2021, while performing well in the stock market, the gross profit margin increased from 9.5% to an amazing 39.8% as a result of eliminating the need to go through wholesalers. And with all that, last year's growth from 372,000 to 1,160,000 registered users also showed an increase in subscriber numbers, showing this company's ability to better monetize the company brand than has been shown. Number 9. Valero Energy. It's no secret that Valero Energy in the stock market is one of the most successful oil and gas refiners and marketers around. Because the industry's prices have been growing rapidly, rising inflation rates and high demand are leading to increased margins. The company's EBITDA increased by a whopping 178% year over year as of March 31st. And the top and bottom line beats are evident in the company's latest results, with an EPS of $2.31, beating expectations by 66%, strengthening its position in the stock market. More than that, sales of $38.5 billion were higher than expected by $6.3 billion. So, in order to free up cash flow, Valero reduced its long-term debt by an impressive $750 million in the last year alone. Furthermore, the dividend profile of the energy giant is exceptional, as its stock delivers a healthy 3.1% yield with a payout ratio of 63%. Number 10. Netflix. Everyone loves to criticize Netflix, but we know you're munching on selling sunset. The current Netflix drop is unprecedented in our opinion. Yes, it was the first time in the company's history that growth did not go as planned. It's true that they're trying a little too hard to be politically correct, and their bumbling is inconsistent, but the majority of you are watching on Netflix. And with that, Netflix stock price has fallen 75% in the previous 6 months, but has continued to grow in revenue year after year. Fundamentally, the company is doing well, but the stock price has responded in an absurd manner in the stock market, even though competing streaming businesses are carving out their own niche. We have no reason to assume Netflix is meant to be this overlooked stock, so it's just a matter of time until the markets are correct. However, the stock market is always changing, and individuals wishing to invest must be aware of its regular ups and downs. So, the greatest way to diversify your portfolio and invest in new company stocks is to study and analyze what's best for your long-term interests. Everything we've mentioned today is our personal point of view, and the only way to gain financial education is to get in the game. Make your investments in the stocks you believe in, and in a few months, hopefully, we'll all be significantly richer. We've made it to the end of our video, and we hope we've inspired you. We also hope you've gained valuable knowledge with the gems we shared today. Thank you for staying with us till the end. Make sure to like and subscribe for future videos so you'll never miss out. We have new ones every week. Thank you for watching, and we'll see you on the next one.